From the College by the Lake, Coeur d'Alene, Idaho. From the College by the Lake, Coeur d'Alene, Idaho. Local, regional, national, and international guests discussing the issues and topics affecting the way you live are on Forum, the North Idaho College Public Forum, with your host and moderator, political scientist Tony Stewart.
As you well know, last year the Congress of the United States passed a bill and the President of the United States signed it dealing with the tax issues or tax changes, and it is our great purpose today to provide for you information that would be helpful to you as you are preparing your federal income tax. And therefore, I'm very pleased to welcome to the program Lorraine Landwehr, who is a certified public accountant. She's with the firm McCall and Landwehr, located in Hayden Lake, Idaho. Lorraine, it's such a pleasure to welcome you to our program, and I can testify to your expertise, and I know you're doing a lot of work for your clients and also for our program here, and we thank you for coming and answering our questions today concerning something that's very important to those who pay income taxes.
Thank you for inviting me.
Let's go right into the first question. I'll say
Sure.
to our viewers that since this is so technical and I'm not an expert in this field, that I have prepared a script, and I'll read my questions from that so that I get it correct and you can respond in a very accurate way. Last summer, as I indicated, a new income tax law passed. It was called the Taxpayer Relief Act of 1997. And there has been a considerable amount of discussion within our society about these changes and general confusion, I would also say, as to how these new rules actually affect people. What do you feel are the more important facts that the average person needs to know as they implement this new law in reporting their income?
Well, Tony, the new law contains hundreds of provisions. For example, this is what every CPA in America is carrying around with them these days. And by the way, this does not even contain the technical corrections bill. But just so you have an idea of what we're up against, there are hundreds and hundreds of provisions. But the areas that are the most common, judging from the inquiries that we're receiving from our clients at our firm, are in the areas of capital gains, resident sales, Roth IRAs, various kinds of tax credits, and also there are some changes in the estate tax area.
Well, that's really showing us what we're undertaking here. My second question then would be, what are the changes regarding capital gains? Let's start with that particular one.
Sure. The new law gives lower income taxpayers a benefit that they never had under the old law. If you are in the lowest tax bracket, which is 15%, the new capital gains tax is at 10%. Now, the tax on capital gains is 20% for all other taxpayers. Now, by all other taxpayers, I mean the individuals, the estates, and the trusts. This does not apply to corporations. Okay. Now, under the old law, capital gains were taxed at the regular tax brackets, but they topped out at 28%. So you see that only those people in the really higher tax brackets, greater than 28%, were receiving any sort of benefit. Now we have three types of capital gains. The short-term gains are taxed at the normal rates. For those are for assets held for 1 year or less. The second is a midterm gain, which is something new. It's midterm gains are taxed at a maximum rate of 28% for assets held more than a year and less than 18 months. Now the definition of a long-term gain, they are taxed at a maximum of 20%, but are for those assets held more than 18 months. And as I said before, this long-term rate is 10% for those people in the 15% tax bracket and 20% for the others. Now, it is also important to note that there are some assets that are not eligible for this particular capital gains tax rate, or the lesser rate. For example, there are collectibles such as artworks and gems, stamps, coins, those sorts of things are ineligible. And the other area is the sale of depreciable real property. The gain on sale of property that has been depreciated, such as a rental house, for example, the depreciation that had previously been taken is taxed at 25%. Now, the remainder of the gain then is taxed at the 10 or 20% rate, depending upon the taxpayer's bracket.
Well, that's very interesting, and will be very helpful to others as we go through this, and we have a number of other things to cover. But my next question would be then, will you describe the old versus the new rules regarding the sale of a home? And I might add to that the homeowner is going to have some real changes here if they wish to take advantage of, particularly some individuals. And so Would you take us through that?
Sure. In fact, this is one of the most exciting parts of this new legislation, and it really will affect a lot of people. The way it worked under the old law, the gain on the sale of a primary residence was deferred if the net sale price was reinvested within a 2-year period. Now, also at age 55, a taxpayer could exclude up to $125,000 of gain on the sale of his home. Now, under the new law, these rules are no longer in effect for sales occurring after, I should say on or after May 7th, 1997. Now we have an exclusion of $500,000 of gain for married couples filing joint returns and $250,000 for single taxpayers. There is no requirement to reinvest the sales price. So, in other words, taxpayers get to keep the profit on the sale of the residence. Now, to be eligible for this new exclusion, a taxpayer must have owned the home and occupied it as a principal residence.
Living in it.
Living in it for at least 2 of the 5 years prior to the sale. This means, though, that every 2 years the gain from a primary residence sale can be excluded. Now, this is great for those people who like to buy a lower priced property, fix it up, and sell at a profit. And really what we have here is the government has effectually removed the profit on principal residence sales from taxation. Now, this is interesting. I believe, and I have heard this said more than once, that this should not make a significant difference to the U.S. Treasury. Under the old law, most people were buying replacement homes, they were deferring gains, and finally at age 55, they were excluding the $125,000 of gain. Consequently, there never were large tax revenues collected from these residence sales. And I mean that as a percent of total tax revenues, this percentage was quite small. But now this is great because the gains from sale of a personal residence can be reinvested in other assets than just real estate. Now, something else to note here, and I think this may affect quite a number of people. In the past, the taxpayers who are over age 55 may have passed up the $125,000 exclusion. And the reason for this is because it was a one-time only exclusion.
In a lifetime.
Right. In your lifetime, you could only take that exclusion once. And there are many people at age 55 who think that there might be a subsequent sale sometime in their life when they would want to use that exclusion. So if now with this new law change, the failure to claim the $125,000 exclusion was a missed opportunity. If the year of the sale was less than 3 years ago, the person may want to file an amended return, claim the exclusion, and possibly receive a refund. Now, also, something else that's important here, the new law specifically states that the new exclusion does not apply to the extent of any depreciation claimed for business or rental use of the home for periods after May 6th, 1997.
Okay. This is very important information. My next question then would be, since we are on the subject of gains and investing, and a lot of our viewers would be in that situation, why don't you discuss the advantages and disadvantages of the new individual retirement account? That's something that's been in place for some time, but there's some major changes, is my understanding.
That's right. The original individual retirement account, that we've always had around the deductible IRA, it's still there. However, what we've added to this is the new Roth IRA, which is named after Senator Roth of Delaware. This is a non-deductible IRA, but the contributions and the earnings are tax-free coming out. In other words, it is a back-loaded account. Now, eligible taxpayers can make up to $2,000 of contributions to a Roth IRA each year, beginning in 1998. If you are single with income in excess of $110,000 and married with income in excess of $160,000, you are ineligible. Obviously, Roth IRAs will have a particular appeal for those taxpayers who are barred from making a regular deductible IRA contribution. And generally, the reason a taxpayer would be barred is because they are a participant in an employer-sponsored retirement plan. For taxpayers who qualify for both types of IRAs, however, this choice is not clear-cut. For example, taxpayers currently in a high tax bracket, but perhaps expect to be in a lower tax bracket during retirement, may find the deductible IRA the best bet, since the deduction is sheltering income that is being currently taxed at a higher rate. The Roth IRA may be the better choice when the tax rate is lower for the taxpayer now than it is expected to be, in future years. Now, converting an existing IRA to a Roth IRA is quite another story. And I should point out right here that if modified adjusted gross income is in excess of $100,000, that taxpayer is not eligible for conversion in any case. But for all of those other folks who are considering conversion, it takes considerable planning and a fair amount of guesswork about the taxpayer's future tax picture. The conversion will cause the IRA to be taxable now. However, there would be no premature distribution penalty, and the earnings in the new Roth IRA are tax-free when distributed. So there are a lot of variables to do with a person's financial situation, their anticipated financial situation, and I think this is an area where your tax professional can really be of help. And even to make this decision more difficult, we have no assurance of what the tax laws will be in the future.
So there's some gamble in your decision.
There is definitely a gamble here. Now, while we're discussing IRAs, I need to point out one other thing, and I'm sure that there are a number of people who are not aware of this. The non-working spouse $250 deduction has been raised to $2,000 beginning in 1997. Now, beginning in 1998, taxpayers will be able to establish education IRAs and make non-deductible contributions of up to $500 a year for each beneficiary under age 18. And this beneficiary does not have to be your child. It could be your grandchild, for example.
With that in mind, then perhaps we should move on to the new tax credits and share that with our viewers also.
Okay, first of all, we really have a magnificent little gift from Congress. Beginning in 1998, if you have a dependent child under age 17, you will receive a tax credit of $400 per child. This is a credit that is a straight reduction in the taxes you owe.
It's actually, you just subtract that from the tax you're going to pay.
That's right.
It's not credit on the tax, it's a reduction.
It's an actual straight $400 reduction per child.
So with 3 children, that'd be $1,200.
Right. I think Congress was trying to tell us all Happy New Year or some such thing.
Well, how nice. What are the education credits all about? Because that comes in relation to this particular law, too.
Yes, we have two. Beginning in 1998, eligible taxpayers can claim the Hope Scholarship Tax Credit and Lifetime Learning Credit. Now, these are for qualifying education expenses. Qualifying expenses are basically limited to tuition and enrollment fees. For example, books, living expenses, student activity fees, athletic fees, all of those sorts of things would not qualify. The Hope Scholarship Credit is effective beginning January 1st, 1998, and it is only allowed for the first 2 years of post-secondary education. Now, it is available to the taxpayer, taxpayer's spouse, or dependent, and the maximum amount of that credit is $1,500. The Lifetime Learning Credit works a little differently. First of all, it is effective July 1st, 1998. It is allowed for tuition paid to an eligible educational institution, but this one is expanded to include expenses to acquire or improve job skills. The maximum credit per year is $1,000. The Lifetime Learning Credit is a per taxpayer credit, while the Hope Scholarship Credit is a per student credit. Now, certain taxpayers will not qualify for either credit. Again, it has to do with your income. If you're single and your income is in excess of $50,000, or married filing jointly with income in excess of $100,000, you will not qualify. And also, it is important to remember that the taxpayer claiming the dependency exemption is the same as the taxpayer claiming the credit. So for those people in high income groups who could not qualify, in some situations, it may be beneficial for parents to deliberately make themselves ineligible to claim their children. And let me give you an example of that, how that could work. You could provide the child with their own income source, for example, by gifting stocks or bonds, or providing part-time employment, in the parent's business or something along that line. Then, see, this income can be used for educational expenses. The child files their own income tax return and takes their own personal exemption and becomes eligible to take the credit.
That's very interesting. What do you think of the changes in the estate tax area? A lot of people obviously accumulate some things in their lifetime, and some people a lot. And what is the effect on the average taxpayer under the new revised law?
Well, Tony, undoubtedly, the most significant change is the increase in the amount of property that each person can leave free of estate tax. Under current law, up to $600,000 of property can pass tax-free. In 1998, this allowance will climb to $625,000 per estate, and it will gradually increase to $1 million by the year 2006. Now, maybe I should illustrate by giving an example of a typical family situation. John Smith dies in the year 2006. He leaves $1 million of assets to his wife, Joan, and he leaves $1 million of assets to a trust that is qualified to utilize the unified credit. Okay, then because of the marital deduction, the Smith estate, it does not owe estate tax, and that is on the assets going directly to the wife, to Joan. The tax on the assets going to the trust then is offset by the unified credit, or the $1 million exemption. Mm-hmm. When Joan dies and leaves her $1 million, her estate then gets to use a $1 million exemption. So the net effect is that John and Joan Smith have left $2 million to their heirs tax-free. Now, also the new law does conform the estate tax filing requirements to reflect the new exemption amounts. In other words, what I'm saying here is that an estate tax return is not required unless the value of the estate exceeds the exemption amount. However, I should point out that every state law is different, and those filing requirements will not necessarily follow federal law. So Idaho inheritance tax law, for example, may be different, or Montana, or whichever state.
Or it takes some time for them to change their laws to complement the federal law.
Well,
possibly.
and they don't necessarily conform to federal law.
But they could if they wish.
They could if they wish.
Okay. What else can you tell us in the time we have left about the complexities of this tax law? Some statistics on why we use accountants.
Why we have this huge, giant tome. Well, let me tell you a few of these interesting facts. I just read these the other day. This is about the size and complexity of the Taxpayer Relief Act of 1997. There are 36 retroactive provisions. There are 114 changes effective on the date of the President's signature, which was last August. There are 69 changes effective January 1st, 1998. There are 5 changes effective after 1998. There are 285 new code sections. There are 824 code amendments. And to assist us in understanding congressional intent, there is a 225,000-page conference committee report.
That's for midnight reading.
Yeah.
You've been so kind to bring, and Lindy Turner, who is our director, has worked and put it in our system. We appreciate it. We're going to put the table up. There goes the table now. And would you share with our taxpayers who might not be familiar with this? This is a single tax rate schedule.
Right. And the way this works is that everybody is going to have some of their income taxed at the lowest rate. In other words, if you're single and your taxable income is between $0 and $24,650, the tax is at 15%. And the part of your income that is taxed at 28% is only the amount over $24,650 and up to $59,750. And then as the table continues on, you can see how that works. So between $59,750 and $124,650, it's at 31%, but only that portion is at 31%.
Right.
Okay.
So
that's when you hear the expression marginal tax rates, that's what's meant by that.
Now we have the married.
It works the same way. Up to $41,200 of taxable income, married filing joint returns, is at 15%, and then there's quite a gap there between $41,200 and $99,600 is 28% rate, and then $99,600 to $151,750, 31%, and so on, as you can see on the table.
The rates, the tax rate is the same: 15, 28, 31, 36. It's just that more money is involved because you've got 2 people, or at least 2 people involved in income.
That's right.
And so, but it's easy to remember these percentages because they're the same in both tables. One other thing on this that a lot of people don't understand,
Yes.
and that is they will look and say, okay, a particular couple or an individual makes $63,000, but they're not necessarily paying in that category and that rate because they have deductibles that can bring them down into a lower bracket and lower percentage.
That's right. What happens, I think, is I've noticed this with my clients over the years, and I think I have most of them educated now, but they don't really always understand the difference between adjusted gross income and taxable income.
Right.
Adjusted gross income is all of your earnings less certain kinds of adjustments to income, and it generally is the bottom line of page 1 of your Form 1040. But then taxable income is this adjusted gross income, or AGI, reduced by your deductions, things like your home mortgage interest, property taxes, and your personal exemptions.
Sure.
Then we get to taxable income, and that's what these rate schedules is based on, taxable income, of course.
That's good. That's a good point, Mr. You have a few more things you want to tell us about the new law. Why don't you share that with us?
Well,
a few more highlights.
There's a few more highlights. We're back to the Roth IRA and the idea of converting, for those taxpayers who decide that they would like to roll over an existing IRA into a Roth IRA, they need to be aware that the tax on the distribution is prorated over 4 years if they roll it over in 1998. That is, say for example, the tax is $20,000. They would pay $5,000 in 1998, 1999, 2000, and 2001. This is not an election, by the way. It is mandatory. Now, if the rollover occurs in 1999 and subsequent years, 100% of the tax is due in the year of the rollover. Now, also under the old rules, the IRA deduction was not allowed for either spouse if income was too high and one spouse belonged to an employer-sponsored retirement plan. Beginning in 1998, the spouse who is not an active participant in a retirement plan may be able to qualify for a deductible IRA. This is really good news. The contribution, if their adjusted gross income is not over $160,000, is where the break is. Now, also there are some new tax breaks for those persons who need to make early withdrawals from retirement plans. Ordinarily, if withdrawals are made before age 59 and a half, there's a 10% penalty, as well as the ordinary income tax. Under the new rules, there are some new exceptions to that penalty. It does not apply to withdrawals that are used to purchase a principal residence for a qualified first-time home buyer. Now, let me define this. The qualified first-time home buyer does not have to be the IRA owner. It could be a child or a grandchild, for example. An individual qualifies if he or she did not own a principal residence within the 2-year period before the purchase of the new home. The penalty-free withdrawals for first-time home purchases are limited to a lifetime cap of $10,000 per individual IRA owner. So it's important. We don't want people to think that they can just run around and buy new houses for every member of the family and start getting penalty-free withdrawals from their IRAs. There is a $10,000 cap, lifetime cap. Okay. Starting in 1998, penalty-free IRA withdrawals may be made to pay higher education expenses for the IRA owner, and this could be for the spouse, for a child, for a grandchild. And in this case, qualifying education expenses are different than when we were talking about the credits, the Hope Scholarship and the Lifetime Learning Credit. Qualifying education costs include, for the penalty-free IRA withdrawal, tuition, fees, books, supplies, equipment, even room and board for post-secondary education, that kind of thing. But this law is complex. There are, as you heard me say earlier, lots and lots of provisions. I really believe that anybody who is considering any of the things we've been discussing, the residence sale, any of the capital gains, all of these are complex issues. Taxpayers need to be aware that they need to be consulting professionals.
You've been so good to spend time with me prior to this program and educate me to some of the changes. And I'm going to have a couple of reactions, and then you can tell me if I'm off base, because I am not the expert. One thing that's fun about doing this program is I get to ask questions to the experts. I don't have to be one. As you took me through all of these different things that we've also shared with our good viewers, I sense that this particular change that took place in 1997 was really focused on the middle class in America, the middle income people. Would you react to my observation?
I think that's true. As you noticed in many of the statements that I made, that there's always some adjusted gross income cap.
Right.
And so that is very true, Tony. There are a lot of things that really help the middle class taxpayers and the lower income taxpayers. Now, that doesn't mean that the higher income groups are excluded. Mm-hmm. Let's just use an example. The $500,000 exclusion on the gain of a residence sale. Okay, so for example, you had a $600,000 gain.
Right.
A $600,000 gain is considerable, but you would still exclude $500,000.
Which is significant.
You have $100,000 of gain that's taxable, but at the 20% new rate.
Not 28.
Right. So you have a $600,000 gain, and you only pay $20,000 in tax.
Plus, you could, being very innovative in all this process, you could do this over several years and do it 2 or 3 times, and you'll be talking about 1.5 million or 2 million.
Well, you're not likely to have gain that quickly.
Depends on if you're wealthy enough to move around in some parts of the world where the value goes up. I understand that, but I'm glad you corrected, because although it does focus a lot on the lower and middle income, there are advantages too for those who are even in higher income.
Oh, certainly, particularly in this capital gains area.
Mm-hmm. And we got about a minute left, a minute and a half. My other response would be, should not people sit down and take a look at what they've heard you say and be very thorough with their records and go to their accountant, because we didn't have time on the program to deal with everything.
Right.
And they should. What I hope that we've done, we've educated them to know what particular questions they should ask their certified public accountant or whoever does their taxes.
Yes. Do
you have any other quick recommendation of what would be helpful as they come in to see their accountant?
Oh, no. The only thing is that we want to make sure that we really have all of the detail and all of the information. So if we do have gains and losses, we need to know all of the dates of acquisition, mm-hmm. the original cost, what you sold and what date it was sold and that sort of thing. And I would be happy to have questions directed to me.
That's on the screen now, the question. If anyone has other questions they'd like to ask you.
Right. I mean, we would be happy to assist people if there's confusion as a result of my statements.
Right. But certainly, I heard throughout this whole report, dates are important. How far you can go back on to get that credit that you need. So thank you, Lorraine Landwehr, for being with us. It's been so informative. And ladies and gentlemen, I hope you have found this program as informative as I have, and I believe you have, to help you as you proceed through this year and next year and the changes in the taxes. I would like to invite you to be with us again next week at this same time, when we will discuss yet another issue. Until then, please have a good week. I am Tony Stewart.
The North Idaho College Public Forum was videotaped live from the studios of Instructional Technology on the campus of North Idaho College for viewing at this more appropriate time. We invite you to join us again next week for another all-new edition of the North Idaho College Public Forum on this public television station.